dive. Today, we're looking at a few sources that really map out some core anxieties in the global economy. Think stressed banks, trade tensions.
Yeah, it's quite a mix.
Definitely. We want to pull out the key insights on, why traditional investment approaches might be hitting a wall and what big macro forces you should probably be tracking.
And what jumps out, right away across this material is gold. It's just screaming.
Screaming how?
Well, its persistent rise seems to be signaling that the very foundations, the global financial system, they're facing some pretty severe systemic challenges.
Okay, systemic challenges. Let's unpack that. We can start with this source, challenging the current investment framework. It basically argues the whole fiat currency system is looking shaky just because gold is hitting new all-time highs. And for investors, the takeaway is the absolute need for positive real returns, not just nominal gains, but gains that actually beat inflation.
Exactly. And if you connect the dots there, the standard asset allocation model, your typical 60-40 portfolio, it assumes fiat currency is solid, right?
Yeah.
It holds its value.
Right.
But if fiat is, debasing and gold up 50% this year against the dollar kind of suggests it is, then the loss of purchasing power for all the world's bonds is gigantic.
Gigantic. Wow.
Yeah. We're talking 1/3 of the world's safest bonds now offering 0 or even negative real returns. And that's before fees.
Wait a second. So if bonds, the traditional safe asset, are basically guaranteed losers in real terms, how does that classic 60-40 portfolio even make sense anymore, according to these sources?
Well, that's the dilemma, isn't it? It's becoming much harder to justify. And you see the fallout from this in the source called the asset allocation dilemma.
Okay.
Even though gold has been, one of the best performers this year, most investors, they seem stuck in that comfort zone of stocks and bonds.
So they're not really allocating much to hedges like gold or crypto.
Very little, comparatively. They're delaying what seems like a necessary strategy shift, maybe hoping things just go back to normal.
Interesting. Okay, let's shift gears to policy. This source, the chairman gets a B+ for it, looks at recent Fed signals. Chair Powell seemed to indicate that the risk to employment now outweighs inflation concerns.
That's a big shift. It means policy is pivoting away from just fighting inflation. Now it's explicitly about preserving jobs.
Right. And there's another detail in there, too, about the balance sheet.
Oh, yeah. Crucial point. Powell noted that the big balance sheet reduction, quantitative tightening, QT, it's nearing its end.
Why?
Because they're seeing signs of market liquidity tightening up. Basically, they can't keep pulling money out of the system much longer without risking, breaking something.
Okay, breaking something. That leads us nicely to the next source, macro and micro woes. This one points to immediate wobbles in the financial system, like stress in the U.S. short-term interest rate curve.
Yeah, that gap between SOFR and the Fed funds rate. SOFR is what banks actually charge each other for overnight loans.
And that gap is rising.
It is. That SOFR spike, it's a classic signal of systemic worry. It means banks are getting nervous about lending to each other again, especially after the First Brand's bankruptcy rattled confidence, particularly around regional banks.
And internationally?
Well, look at Argentina and South Korea suddenly needing U.S. dollar swap lines.
So emergency dollar access.
Exactly. That demand for emergency liquidity is a major stress indicator. Suggests potential solvency issues bubbling up if they don't get those dollars. And at the same time, you see gold prices going, the source says parabolic.
Wow. Okay, so financial stress, and it seems linked to geopolitics too. This source, Ripple Effect, talks about the market ending the week pretty sourly. Why was that?
Well, a couple of things hit at once. Trade talks with China broke down, partly triggered by threats of 100% tariffs.
And that was tied to rare earths.
Correct. China took a negative stance on exporting rare earth metals. These are absolutely essential for, defense tech, batteries, all sorts of modern industry. So that threat really spooked the market.
What else hit the market?
You also had the First Brand's default rippling through private credit, which is a big opaque market. And then the unwinding of the yen carry trade added fuel to the fire.
Right, the yen carry trade, borrowing cheap yen to buy U.S. assets.
Exactly. When that unwinds, investors are forced sellers of U.S. assets to pay back those yen loans. So it hits markets broadly, a real cascade effect.
Okay, let's dig deeper into that China tension with negotiations roadblocks. This source points out China is using its dominance in rare earth metals as serious leverage against the U.S.
Yeah, they control most of the extraction and processing globally. It's a powerful card to play.
And the consequence mentioned here is Well, it's kind of shocking. It says this conflict is pushing the U.S. towards actions you'd normally associate with, like socialist regimes.
It's talking about proposals to potentially take control of critical private companies. Intel, U.S. Steel are mentioned as examples, all to secure domestic resources deemed vital for national security.
So China's basically saying,
The message seems pretty clear. The U.S. isn't the only superpower calling the shots anymore. No longer the only sheriff in town, as the source puts it.
and it's not just the U.S. feeling this pressure, right? The source trade conflicts brings in the EU angle.
That's right. Look at the Netherlands. They actually took control of a Chinese-owned chipmaker subsidiary there, Nexperia.
On what grounds?
National security.
Yeah.
They used something called the Goods Availability Act. It's basically policy designed to let them control critical supply lines if needed during international crises. Shows how trade, tech, and geopolitics are completely tangled up now.
Okay, so let's try to summarize the takeaways for our listeners. We've got systemic risk, maybe localized in regional banks and private credit for now.
Okay.
We have a Fed that's clearly pivoted policy toward supporting employment. And maybe the biggest underlying challenge is this potential debasement of the fiat currency system itself, highlighted by gold's run.
That really covers the core points, and it leads to a pretty fundamental question for you, the listener, to think about.
Given everything we've discussed, critical assets like rare earth being weaponized in trade conflicts, nations using national security laws to effectively seize assets like Nexperia, how much does the security of your supply chains now weigh against traditional financial risk when you're making portfolio decisions? Is that balance shifting fundamentally?